But here's effectively what happened, ladies and gentlemen. You had earnings come in. Revenue was up 2% year on year. And adjusted net income up 38%, adjusted EPS up 35%. So overall, headline was fine. Revenue was a hair slighter than expected. Earnings crushed it. And you had the stock sell off. So why did the stock sell off? Let's go through some of the things I posted on Twitter today. Okay, I said, imagine owning Amazon AWS cloud business on a standalone basis in 2016 before its growth run. Remember, they're going to IPO, they're doing a tax-free spin of AWS. So that will be a standalone ticker to shareholders. That's what's happening with Baba Ali Cloud with this announcement. So let's take a look here. Okay. Our board has approved a full spin-off of the Cloud Intelligence Unit via stock dividend distribution to shareholders with intention for it to become an independent, publicly listed company. So here's basically where Ali Cloud is today. In 2016, AWS was doing $12 billion of revenue. Ali Cloud is just a hair below that, with very low operating margins. And as the top line grew, by the time it grew to $30 plus billion, which is where we expect it to be by 2025 if McKinsey is right, the operating margin was at 29%. So that's where you get to scale, because the fixed costs are relatively static, and it all flows to the bottom line. So as a public company, they're going to be focused on profits. They're not going to be dragged down by the money-losing divisions like entertainment and garbage like that, which makes no difference. And that's where we're going to get a monster value unlock. So just think of it in terms of $10 billion value unlock, operating income. In 2021, the whole business had $16 billion and it traded at 319. If we get back to that level of multiple expansion, and we will once the euphoria comes back following despondency, it always does, whether it's 12 months, 24 months, it doesn't matter. The key is we all want it to happen faster. It happens when it happens. But when it happens all at once. I've been to this movie before. At that multiple, you'd be looking at, basically $200 a share in Ali Cloud alone. So that is monstrous when you think about it, and that's what they decided to do today as far as the value unlock. Now, I also want to go through the cash flow, because Alibaba generated $4.7 billion of free cash flow this quarter versus a loss of $2.4 billion of free cash in the same period last year. So for this year, Alibaba generated $25 billion of free cash flow in the last 12 months versus $15.6 billion the year before. That is huge, a 60% pop, give or take, on free cash flow. Basically, they generated enough cash to buy in 10% of the company at these prices, and their cash flow generation is growing. We think it's going to be $30 billion over the next $30 billion a year within a couple of years, up from 25. So hold on, I have to get my magnifying glass to just see where it's down exactly, because it's doing exactly what it did. You had euphoria in 2014, then it crashed down, and it took about a year and a half or so to find its sea legs, and then it started to work its way up. Then you had a shakeout, and then you had the parabolic move. Same exact thing here in 2018. It crashed down. It took about a year and a half to find its sea legs, and then it had its parabolic move. And this is exactly what we're doing right now. It crashed down. It's taken about a year and a half, and now it's starting to find its sea legs, and we're going to have a parabolic move. There's no question in my mind based on the value. And especially as I went through today, unit by unit, going through the sum of the parts, it's just mind-boggling. So there's the free cash flow you can see right there. And then the next thing is, so you can see, is this was 2022, where they lost $2.4 billion of cash and generated 15.5 on the year. And then 2003, ending this first quarter, they generated 4.7 in the quarter, 25 billion in the year. And this is a business that generates 25 billion of cash, and people are selling it like it's a pot stock. It's unbelievable. But that's what creates the opportunity. Baba finished the quarter with $87 billion of cash, or enough to to buy in 37% of the shares outstanding if they choose to. Let me repeat that. They finished the quarter with $87 billion of cash, which is enough to buy in 37% of the shares outstanding at this price. So considering they generated $25 billion of free cash last year and will likely exceed that materially this year, they have a lot of options to unlock value for shareholders moving forward. And you can see it right here, $87 billion of cash, which is just awesome. So moving right along, we had what did they do with that? Did they buy 37% of the company when the stock was at $80 a few weeks ago? No. They bought $1.9 billion of stock this quarter, or 40% of the free cash flow that they generated in the quarter. Very conservative. On that basis, we should see about $12 billion of buybacks in the coming year, which is about 5% of the company. Daniel Zhang needs to go bigger with that $87 billion cash on the balance sheet, and more on the way. So they bought 25 million ADSs, which is about 1.9 billion under the existing share repurchase program. They still have 1.94 billion remaining under the current authorization, which goes through March of 2025. So over the next 2 years, they can buy another 19.4, but more likely than not, if they continue to buy at 40% of free cash flow, they'll use up 12 of that this year plus, and then they'll extend the authorization or increase the authorization, and they should do it aggressively. Someone asked, why don't they just do it all right now? They should do it all right now. There's no question about it. My sense is they want to go to the market from a position of strength. As they're IPOing all these companies, they want to convey to the market, we're IPOing these companies not because we need to raise cash. We're IPOing these companies to unlock the value. So we're going to raise capital at valuations that are acceptable to us and acceptable to what they should be, not acceptable to what they are in the conglomerate format. And if you don't want to pay those prices, we just won't do it right now until the market gets hot, because we have all the cash we need. And that's a smart move to come from a position of strength. You know, it goes to, I think I talked about my favorite movie of all time is Swingers with Vince Vaughn and Jon Favreau. And they're driving from Los Angeles to Las Vegas. And Mike is played by Jon Favreau, and Trent is played by Vince Vaughn. And Vince is in the car. Mike's driving, and Vince is in the car, putting his suit on while they're driving that long drive from LA to Las Vegas. And Mikey turns to Trent and he goes, well, what's with the suit? And he said, because in life, or, well, not in life, it's a metaphor for life. When you don't need the S is when they give you the S. And I think that's how Baba's management is positioning. Just like Trent was putting the suit on so he would get all the comps at the casino, Alibaba management wants a boatload of cash, so when they go to market with these 6 divisions, they can dictate what the valuation is going to be versus relying on the kindness of strangers, so to speak. Baba International Commerce Unit is expected to IPO at a $39 billion valuation. Don't expect it to stay there with 41% year-on-year growth. This could be a big value unlock going forward. So let's just take a look here. International retail business increase of 41% compared to the same quarter 2022. This increase was primarily due to the growth in revenue generated by Trendyol, Lazada, and AliExpress. The increase in revenue from Trendyol resulted from more efficient use of subsidies and robust year-over-year order growth. The increase in revenue from Lazada is driven by the continuous improvement in monetization rate by offering more value-added services and robust year-over-year order growth. And the increase in revenue from AliExpress was driven by the double-digit order growth of AliExpress, accelerated by the direct sales and fulfillment services with the launch of a new service, Choice, to global consumers. So that's big stuff. And then here's Alibaba's global IPO. Unit has been valued by as much as $39 billion by analysts. So you just add the sum of the parts. We'll get it realized as it goes out to market. Okay, so Baba's cloud business was up 4% for the year, but slower than the industry, which was up 10% for the year. This was due to two one-time events. Number one is the loss of TikTok's international cloud business due to the US regulation. Remember, they had to slowly push that all over to Oracle, so that's been ongoing. That was their largest customer, so that's hurt them, no question about it. And number two, the January COVID resurgence delayed delivery of the hybrid cloud projects. They certainly need to do better. There's no question. And I think on a standalone basis, when they're focused exclusively on that, they certainly will, and we'll see the benefits of that. So I think that was a letdown this morning. Here's the clip from the McKinsey thing. You can go on our reads today and pull the whole McKinsey 15-page report where they talk about the cloud being $90 billion in China by 2025 and tripling from $32 billion. This is also another thing that's probably been a little weight on Alibaba of late, which has been the US dollar. This is a core part of our thesis. If you remember, here the US dollar was going up this whole period. Baba was crashing. The US dollar peaked in October. Alibaba rallied 100% off the lows. As the dollar crashed, then the dollar strengthened. Alibaba crashed again. Then the dollar weakened. Alibaba rallied. Now the dollar's starting to get bid. Alibaba got weak. So we have a little strength in the dollar because of the flight to safety with the whole debt ceiling thing. Hopefully that gets resolved in the next couple of weeks. Then the dollar should ease off, and then we can get a bid in emerging markets, i.e. Baba, in the coming weeks. This was a note from Jefferies after earnings. They still have their $220 price target. And what they said is Alibaba recorded March results. Total revenue came in largely in line with consensus and our estimates. Consumer management revenue declined 5% year-on-year versus our estimate of 5% year-on-year decline. For adjusted EBITDA, it grew 60% year-on-year, 21% ahead of our estimate. And non-GAAP earnings came in better than consensus. Okay, while Alibaba China Commerce was down 1% year-on-year, they saw growth return to Taobao and Tmall in March. This aligns with the data we're seeing for a monster bounce in April. Takes the patient a few minutes to find his sea legs after a heart attack, but she's coming back. So this is the key thing. In the month of March, underlined, online physical goods GMV growth on Taobao and Tmall, excluding unpaid orders, turned positive. Driven by strong growth of fashion and accessories and healthcare categories. If you remember, 2 weeks ago, we talked about how we expected really good things from Taobao and Tmall because they were concentrated on apparel and makeup. Well, they did see that, but it only started in March due to the January problem, and I guess February people took a little time. But here is from Morgan Stanley, by category, China's monthly retail sales growth. And you can see it only starts to hockey stick in March and April. So we're going to see this in the coming quarter's results. But as you can see relative to last year, this is completely off the charts. And everyone was negative this week because retail sales came in only 18.4% year on year for the country versus 21% expected. But you had 1 month completely off, 1 month to, the patients walking around the hallway with the stick on wheels to make sure they don't collapse, after they just had a heart attack. Now the patient's starting to walk outside. Before long, the patient's going to be jogging on the track. And within a couple of months, the patient's going to be doing marathons again.